Hi everyone, this is Jitan here and welcome to another episode of Traders TV. In the last episode, we talked about the 4 reasons why you must only trade the trend to start out with. By the end of today's episode, you're going to learn exactly how to trade like a central bank. Now, if you're looking for some more of those practical steps on how you can accelerate your trading journey, then click on the link below and attend one of our free Forex trading workshops where you can speak to one of our traders live on a one-to-one basis. In the meantime, let's get cracking with today's video.
Okay, so how to trade like a central bank. So central banks are important because they effectively run the foreign exchange market. It's important to know about them so you can use their actions to your advantage. Now, of course, this is going to be slightly more advanced, okay, from a beginner trader, but still worthwhile identifying the tools that you have available to you. So what are central banks and why are they important? Well, central banks are independent institutions whose role is to maintain price stability within their currency. They control this price stability through inflation, interest rates, and monetary policy. The world's 4 largest central banks are the Bank of Japan, affecting the Japanese yen, US Federal Reserve, of course, affecting the US dollar, the European Central Bank, affecting the euro, and the Bank of England, affecting the British pound. These are the 4 main central banks, and the reason these are important is because later on you'll understand this is how global investors, the people with money to move in the market, make their decisions. So central banks make interest rate decisions based on the level of inflation an economy is going through. So what is inflation? Well, inflation just measures the change in prices of goods and services. Now, to keep inflation in check so that it doesn't get out of control and things start to get very expensive, then central banks will increase interest rates. The reason they do this is because it results in lower growth and it slows down inflation. Inflation because people then are more encouraged to save more rather than spend more because they're getting higher interest rates. Of course, borrowing also goes up as well, so the cost of a loan gets a little bit more expensive because the interest rate rises. So it stops people buying a lot of goods and services. So in effect, prices will come down a little bit, so making sure prices don't get out of control and keep going higher. Now, in a low productive economy, central banks will actually cut interest rates to stimulate economic growth and speed it up. And this is where it starts to produce higher inflation, because then as economic growth starts kicking in, people start spending a little bit more. Because interest rates are so low, there's no point saving, I may as well spend on something. And then prices start to creep a little bit higher. And central banks have to keep this in balance. It's a very fine balance. They don't want inflation to be out of control, but they don't want inflation to be dropping either. So they use interest rate policy to keep inflation in check, or at least try to keep it in check. So why are interest rates and inflation important when trading the Forex market? Well, investors, so global investors, are people who can move the market with trillions of dollars or pounds or yen in assets, okay? They use interest rates to determine where they will put their money. So if you had a choice, for example, between having a savings account which paid you 1% of interest instead of 4% of interest, which one would you choose? Well, out of those 2 options, you'll probably want to go for the 4% interest rate. Now, the key with people who really have a lot of money, the institutional money, sovereign wealth funds and hedge funds and so on, fund managers, now they have more access around the world. So they can go to somewhere like Australia, who is paying out or has a 4% interest rate, and they can put their money in Australia and gain a 4% interest rate, rather than putting it into the Bank of Japan or the Japanese yen, which is only giving you 0.25 or 0.1% interest, right? So they move their money depending on where the best interest rate will be for their capital. Now, this is useful for us because then we can identify where all that money is going and flowing into or out of. However, it's the interest rate expectations okay, which really move the foreign exchange market. Remember this, markets move based on expectation, yeah, rather than the fact, because central banks have to follow a certain monetary policy. It's a transparent, independent body. The tools they have available, the mandate they have is out there in the open. There's going to be a team of analysts at hedge funds and banks looking at this information, and they'll be saying to themselves, well, based on this evidence of what's happening in the economy, the central bank will have to increase interest rates in the next couple of meetings, or they're going to have to cut interest rates in the next few meetings, because they can already tell that information, because again, it's open policy, yeah, it's transparent. And then what happens is the analyst gives that to their traders, and the traders start building positions or start cutting positions depending on which way they believe the market's going to go. And as independent traders, we can then use that to our advantage. We may not know what the central bank is going to do. No one does. We can only put our probabilities in our favor. But if we can see that there's big central bank news activity in the next week or coming weeks, and we start to see the market move in that favor or start to move lower, then already we can see that other people in the market, the other players, are positioning themselves accordingly. So we can trade and capture some of that momentum and some of that wave. Because remember, we're not going to move the market. We don't know better than some of the other traders out there. But we can put two and two together. Big event happening here, people are already buying the market as it's going up. Okay, we can put two and two together and say to ourselves that actually people are positioning themselves, people with the money are positioning themselves for this potential event. So we can trade what we call that expectation. Now this is pretty different from the retail crowd, because the retail crowd, they'll be watching their news feed, BBC news feed or Bloomberg news feed, and suddenly they see, oh, interest rates have gone up, the euro or British pound has been rallying higher, then they will go and place the trade, arguably ending a bit late. Okay, so remember this, market moves on expectations. And in the foreign exchange market, it's these interest rate expectations which can be the most useful for us. Now, as I just said, we're not going to know what the central bank is going to do, but they have to be transparent and open in their comments. Understanding the role of these central banks and the flows of investor capital can be very useful for us as a Forex trader. Okay. So here I want to highlight British pound against the New Zealand dollar. The reason I want to highlight this is because during this move higher, we actually had the anticipation or the expectation that the Bank of England, okay, will increase interest rates. The reason for that is because inflation has been getting really high in the UK. And there's been a lot of chatter about them increasing interest rates to make sure things don't get out of control and things get too expensive. Across the board, during this period of time, we've seen not only pound New Zealand, we've seen pound Aussie, pound against the Canadian, pound against the Swiss franc, pound against all the other crosses, it was actually moving up. And that's interesting because of the potential interest rate announcement, okay? So we can use this to our advantage by understanding what's happening from an interest rate perspective in British pound and the New Zealand dollar. The British pound decision was here, okay, to increase interest rates. The market had already been pushing higher, okay, and then the decision came during this week here, and then after that the market kept on pushing higher. Why? Well, because at the same time there's a double whammy. We had the expectation of the British pound and the Bank of England increasing rates. Obviously, once they've done that, most professional traders bank their positions. But then we've also had chatter that New Zealand dollar central bank may have to start cutting interest rates as well, because they've just gone through a recent election crisis almost, where a new coalition government is in place, and that's sending the New Zealand dollar tumbling across a lot of different pairs. So we've had a combination of political events, okay, one from the central bank and one potentially very new coming in their central bank policy. Okay, so this is why central banks and inflation and interest rates can be quite important. Now, for the most part of it, when you first start trading, the fact is this market is going up. right? Nice and easy. You may not know why the market is going up, but it's going up. And then you're just going to use some of the strategies. So we've got loads of different strategies here to get us, in positions to the upside within this market. Sometimes you may not know why the market is going up. You're just going to capitalize on what you see in front of you. But over time, you start to pick up these things. And if you understand a little bit about why the market is going up, it just helps you stick to the trade a little bit longer and capture those higher reward to risk moves.
So I hope you found that video to be of value. Now, if that was a little bit too advanced for you, then look at our playlist and refresh yourself with some of our previous videos, or better yet, click the link below and attend one of our free Forex trading workshops where you can speak live with our traders on a one-to-one basis. In the meantime, stay subscribed to the channel and watch out for our next video. I'll see you then.